The red line is the annual rate of change of heavy truck sales in the United States, and as you can see, every time in history it went down, the stock market collapsed. Right now, we're seeing a sharp drop in truck sales that began in June 2025. The last time it went this low was during the COVID crisis in 2020. This behavior was seen in the late 1970s, the early 1980s, the early 1990s, the early 2000s, during the Great Financial Crisis, and during COVID. And this mechanism mostly shows that when production in the economy slows down, it is directly reflected in the sales of essential vehicles like heavy trucks. The current drop leads us to believe there might be a potential large correction in the stock market. At Gleneus, we're always focused on providing you with outstanding analysis. However, none of the information provided should be considered financial advice or an investment recommendation. Our goal is serving you the best educational content. Since the start of 2025, the US quietly slammed the brakes on trade by jacking up effective import tariffs. This value now stands at about 16%, meaning on average, imported goods face a 16% tax at the border. In practical terms, a $1,000 imported good carries about $160 in tariff costs before it even reaches wholesalers. Pre-2018, the US tariffs averaged 2 to 3%, which was very common globally. 16% rivals levels last seen in the 1930s, outside of wartime distortions. The Liberation Day drop and rebound in the stock market indicates that this was an uncertainty shock, rather than a systemic shock. To be precise, the primary driver of the stock market is earnings. However, the environment in which those earnings are generated is strongly influenced by inflation. Inflation is therefore a major factor for the stock market. Historically, major inflation spikes have been followed by significant declines in the S&P 500. Over the past year, many analysts have been wrong. For the last 12 months, starting in January 2025, we repeatedly heard that these unprecedented tariffs would cause severe inflation. However, inflation was 3% in January 2025, and it is still 3% today. In that sense, nothing happened. Meanwhile, the United States raised tariffs on nearly every country in the world by a large margin. An inflation rate of around 2% is generally considered economically optimal. As we can see, tariffs are not inflationary in the way we were repeatedly told. Analysts were wrong. When tariffs are implemented, producers are the ones who pay them. They are the only entities that directly pay tariffs. Producers then decide whether to pass those costs on to consumers. In practice, prices usually do not rise significantly while economic growth slows. This is obvious in the decline in truck sales. What is inflationary, however, is money printing. More precisely, the quantitative easing implemented during the 2021 COVID crisis. The M2 money supply in the US economy expanded significantly, which led to a dangerous inflation spike and ultimately triggered a major bear market. Right now, inflation is not the primary concern, but instead, it's the economy is struggling with a weaker growth. Before we continue talking the truck sales, it's important to check on this. We've seen opinions that economy has only a loose connection to the stock market. However, corporate profits are a direct function of economic activity. So while the stock market isn't a perfect mirror of today's economy, it is tightly linked to where the economy is going. In the vast majority of US recessions, equity markets peak and decline before the recession officially begins. The lead time is often 3 to 9 months. Markets usually sniff out economic trouble before it shows up in unemployment and GDP. So it's not that markets cause recessions, it's that they react faster to deteriorating fundamentals. We need to realize that truck sales are forward-looking real economy signals, and stock markets are forward-looking profit discounting machines. And this is why we look at the Dow Jones Transportation Average, as we think on multiple occasions it was actually leading the S&P 500. Transportation companies sit right at the intersection of production and demand. If goods are being produced, they must be shipped. When transport stocks begin to weaken or diverge from the broader market, it very often signals that real economic throughput is slowing beneath the surface. Historically, this has happened repeatedly, most notably in 1972 to 1975, 1990 to 1991, 1999 to 2002, and again more recently, where transports peaked or rolled over months before the S&P 500 followed. In each case, the message was the same. Producer activity and freight volumes were no longer validating broader market optimism. None of the information provided should be considered financial advice or an investment recommendation. Our goal is serving you the best educational content. Thanks for watching. This is Gleneus.